What's going on, YouTube? Today's episode, we're going to be talking about dividend aristocrats. I recently came across this term researching what makes a great dividend stock, and I wanted to share with you all my findings. So we'll get into the definition of a dividend aristocrat, and then also cover some stocks that qualify as a dividend aristocrat. So what is a dividend aristocrat? Well, it is a company that is in the S&P 500, and it consistently pays a dividend to shareholders, but annually increases the size of its payouts. A company will be considered a dividend aristocrat if it raises its dividends consistently for at least 25 years. And we're going to get into some of these key takeaways because I really think they hammer in, what makes these stocks so great. They tend to be large, established companies that no longer enjoy supercharged growth, meaning that they have a pretty high market cap, and they have proven that they aren't going anywhere. They are recession proof, as you can see here, and they've been enjoying steady profits and growing dividends in good times and bad. And also they are dividend aristocrats. They're similar to dividend kings, but the difference is that dividend aristocrats are at the minimum of 25 years, where dividend kings are 50 years. And you're going to see that some of these stocks are nearing that dividend king mark. So let's get into the first stock here. The first one here is Lowe's, ticker symbol LOW, and they have been increasing their dividends for the past 47 years, while their dividend yield is quite low, only 1.31%. They've been still consistently paying out its dividends to shareholders and increasing it every year. And as we can see here, their dividend growth rate the past 20 years has been exploded at 6,328%, and that's a pretty insane growth for dividends. The next one that we'll get into here is Walgreens, ticker symbol WBA. It's been consistently paying out its dividends for the past 46 years, and its dividend yield is currently sitting at 3.93%. Its annualized growth rate, though, it doesn't show all the information here, which is a bummer, but we can see that it's been steadily growing, and it's obviously been growing for the past 46 years, so we can see a similar growth rate here, probably in the thousands of percentage. The next stock here is Johnson & Johnson, ticker symbol JNJ. It's considered a dividend king because it's crossed that 50-year threshold, but its dividend yield is sitting at 2.61%, and its growth rate for the past 20 years is at 541%. The next one here is Target, ticker symbol TGT. It just reached the king mark of 50 years, and it has a dividend yield of 1.35%, with a growth rate of 852% for the past 20 years. And the last one here, ticker symbol O, which is the Realty Income Corp. This is a REIT. You can see that they've been paying out their dividends every year for the past 27 years, and their dividend yield is sitting around 3.97%. The reason why I highlighted these forward payout ratios, as you can see that Realty Income Corp has a payout ratio of 170%. A payout ratio is essentially a term used to signal that the company is going to have a net income, and with that net income, it reserves a percentage of that for its shareholders. As you can see that this is at 170%, so it seems to me that they're overpaying what they've got in net income to its shareholders. And we'll go back and look at some of the other stocks here. Lowe's has a 25.99% payout ratio. So for example, if they had $1 million in net income, $260,000 of that would be reserved for its shareholders to be paid out. And Walgreens here has a payout ratio of 38.8%. J&J has a percentage of 40.85%. And Target has a payout ratio of 27%. I think these are all pretty healthy percentages. I would be a little bit suspect if a company had a really high payout ratio and they weren't a REIT like ticker symbol O. The reason why ticker symbol O has such a high payout ratio is that they have to pay out a majority of its earnings to shareholders. So that's why you'll see that 170%. But yeah, any other company that is boasting, maybe 70 or 80% payout ratio and they aren't a REIT, I would be a little suspect of those companies, mainly because they are, paying out so much to their shareholders and not reserving cash to pay off debts or, reinvest into the company. So we want to really see these payout ratios at a healthy percentage to really ensure that the company is, handling its finances properly. So maybe 20 to all the way up to maybe 50% would be a great indicator of a payout ratio that is for one of these stronger companies. But yeah, all these companies have a market cap well above the billions, and they're companies that have been around for 50 plus years, and I don't think they're going anywhere. As well as the growth of these stocks, you can see that Target has been steadily growing in its share price, as well as J&J has been steadily growing in its share price. So these stocks are decent purchases for long-term investments, with the caveat being Walgreens here. If we take a look, they were doing great and then they kind of stumbled for the past 6 years. So you really have to look into the history of these companies and really look into what they're doing in terms of long-term growth. There's been a few hiccups for the company Walgreens. Amazon announcing that they're going to get into the pharmaceuticals. There's a lot of factors that play here that would make a stock like this dip, but they still paid out its shareholders and they still increased its dividends. So even though the share price dropped, they were still able to consistently hold that line to pay out its shareholders. And Lowe's here has been also steadily increasing its share price. So these are some pretty strong stocks to have in your pocket, and who knows what the next 50 years will hold. But for now, these shares have been doing pretty well for themselves, and I like looking into these companies because it shows me what they are looking to pay out to shareholders, as well as the potential growth, or if there is still room for these companies to grow. And the short answer is, for me, I think they still have a lot of room to grow, and still a ton of dividends to pay out. So yeah, that's dividend aristocrats in a nutshell. If you liked this video, please let me know what your thoughts are below, as well as subscribe to my channel if you find this interesting. I will be talking more about stocks and crypto, as well as tech, reviewing tech, tech jobs, software engineering jobs, things like that. So yeah, we'll get into pretty much anything that I find interesting, and I hope that you all will find this interesting as well. I'll catch you in the next video. Later.